Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. As a value investor, I am a big fan of stocks that pay dividends, using the money for cash flow and, in my case, as grocery money to live off of, without having to dig into the principal while the stock price grows as well. A dividend yield is the current dividend payout divided by the current stock price. So, how much are you getting in dividends as a percent of the money you paid for the stock? So, it's your dividend return. Note that when you buy the stock, you're locking in the denominator since the share price you paid is fixed. However, in addition to the cash flow, there are 3 technical reasons for preferring dividend paying stocks as well. Number 1, the total return is just better. The TSX dividend payers outperformed the non-dividend payers in CAGR, or compound annual growth rate, significantly, and even outperformed the overall TSX, and dividend growers are even better than dividend payers. Dividends contributed 40% to the long-run total performance of U.S. stock market. For some date ranges and stock indexes, the number can be even higher at 2/3. Companies that pay dividends are consistent and steady in their earnings, so they can keep paying the dividends. Companies that grow their dividends show they are improving their performance. Dividend payers have overall better performance. Value investments usually pay dividends and routinely beat growth investments, but that's the topic for next week's video. The second reason is that dividend stocks do best when inflation is high. Dividend payers across the board outperform by the widest margin in these high inflation environments, with an outperformance over 5% annually compared to non-dividend payers. For illustration purposes, the diagram shows the top 20% of dividend yielders and growers. When the US CPI, Consumer Price Index, or inflation, is between 6 and 7%, during this high inflation, we see the biggest outperformance of dividend payers over non-dividend paying stocks. It didn't matter whether it was high yield dividend payers or dividend growers, they both outperformed the non-payers by the highest amount during high inflation. In 2022, dividend payers were down in mid-single digits in the US, while the S&P 500 was down 19%. And the third reason is that dividend payers also do better during volatility in US markets. When the VIX, a measure of volatility, is up at all in a given month, the dividend payers will beat the index by over 1%. And if the VIX is up a lot, 20% for the month, the dividend payers will outperform by 2%. And that is why I am a dividend investor. The performance is better, especially during tough times like during inflation or volatility. Look for companies that have a decent 3 to 5% yield, but also have the cash flow to grow those dividends in the high single digits, let's say 6 to 10% per year, so the payout doubles in 8 to 10 years. Your yield on the amount invested ends up being amazing as the dividend goes up, but the purchase price stays constant and the share price goes up over time as well for the buy and hold investor. If you have any requests on what you would like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.